Good evening. Welcome to this video. In this series, we will be discussing certain aspects of a guide to the documentary credits. We shall look at what is a documentary credit, what is the history, how it is used, what are the uses, what are the types, what are the characteristics, what is a documentary flow, what is a generic way a documentary credit transaction is handled, how it is settled, what are the mechanisms, what are the risks associated with it, and related aspects. This is intended to be a cram video session for preparation to the CDCS examination, Certificate in Documentary Credit Specialist examination. In the part 1, at the outset, we shall have a look at an overview of documentary credits. Basic principles. First, let us look at the history, how the documentary credits came into existence. The documentary credits were there in existence for a long time, almost 200 years now. Trade had been there the moment man had something in excess and had something in shortage and he had to exchange. There was first barter, and then people started to go across to the other communities and ultimately to other continents. So when the traders and merchants were traveling across the continents, there was a need that they may have to pay advances for what they're intending to buy. Also, there was a need that their expenses will have to be met during their business tour and they could not carry cash or gold. So they used to ask their bankers to issue a letter of credit saying that this merchant is traveling to this country and he may need some money, and whatever has been paid to him can be reimbursed by drawing upon the issuing bank. So it was in the form of a letter. It was issued by a bank. It was addressed to a correspondent bank in a foreign country, and it was to support the financial needs of the traveling businessman. This is how the letter started. Earlier, we can call this as a letter of credit for travelers or travelers letter of credit. Thereafter, this was used to support the merchandise also, the goods or the services that are being bought, maybe to pay in advance, maybe to pay later. The correspondent banks used to draw bills of exchange, and the issuing bank used to have them reimbursed. If we look at the history of the letter of credit as it is today, the earliest example that we have, or the sample that we have, is a sample available in the US Library of Congress. It is a letter of credit issued by or signed by the President of US, Mr. Jefferson, and it says that my guys are traveling across the world for various purposes, and whatever his needs are can be or should be paid by whoever comes into contact with this letter of credit, and then it will be reimbursed by the government of US and things like that. This was actually dated 1803. International Chamber of Commerce was established sometimes in 1913, and thereafter it is a federation organization or an umbrella organization of all chambers of commerce. They first developed and published the UCPDC, Uniform Customs and Practices for Documentary Credits. Documentary credits had been in existence for a long time, but ICC, which was established in 13, thought of publishing this Uniform Customs and Practices, a guidance, a rule book, in 1933. The first publication is called publication number 82. It was published in 1933. Before that, there were no standard rules or guidance for the letter of credits. Subsequent revisions to this happened in 51, 62, 74, and 83. Thereafter, 93 was a very popular version, and now we have UCP 600 revised in 2007. This is effective 1st July 2007. We also have a publication called ICC Supplement to Uniform Customs and Practices for Documentary Credits, which is an electronic presentation meant for electronic presentation, EUCP version 1.1. Along with UCP 500, we had version 1. Along with UCP 600, we have version 1.1. We have something called Uniform Rules for Bank-to-Bank Reimbursements for reimbursement under letter of credit, and this is also an ICC publication to support payments or settlement of the payment due under the letter of credit. It is called URR 725. Then we have an International Standard Banking Practice. It is ICC publication number 745. This is effective 2013, and this is called the ISBP. Then we have International Standard Practices. International Standard Practices is meant to support the standby LCs. It is called ICC publication number 590, and usually it is called ISP 98. So these are the various publications that ICC had come out with to facilitate the documentary credit transactions, or in general, the rule book for the trade. What is the definition of a credit? A credit, it's not necessary how it should be named. It can be called letter of credit or a documentary credit or orderly credit or commercial credit or whatever. It's a definite undertaking. An undertaking usually by a bank, addressed to the beneficiary or the supplier, saying if the certain terms and conditions are met and it is evidenced in the form of submission of stipulated documents, then payment will be guaranteed. Who is an applicant? Applicant is a party at whose request the credit is issued. Who is a beneficiary? Beneficiary is a party in whose favor the credit is issued. Who is an issuing bank? Issuing bank is the bank which issues the credit, the documented credit, letter of credit, howsoever we call it. It can be however named. The only requirement is it should be a definite undertaking to pay against evidence of meeting certain terms and conditions, which could be supply of certain goods or services, evidence in the form of documents. Who is an advising bank? Advising bank is a bank to whom an issuing bank asks the LC to be advised. Issuing bank will send Swift MT700 format of message, an authenticated telecommunication for in which the LC will be there, or the format of the LC is called MT700. This will be sent by the issuing bank to the advising bank. There could be a second advising bank, who is the bank who will ultimately advise the LC to the beneficiary and who is acting on the request of the advising bank. So to have an LC, basically we need only two parties, the issuing bank and the beneficiary. It is a promise by the issuing bank to pay the beneficiary. Applicant is not party to credit, but party associated or related to the credit because he is requesting the LC. Advising bank may be a bank who will advise the credit to the LC if the issuing bank cannot directly advise. Nominated bank. A nominated bank is a bank who have been nominated by the issuing bank to make the LC available, which means the LC can be available by side payment or deferred payment, and there should be a bank whom the beneficiary will approach to get the payment under the LC or to get it honored or to submit the documents. And for this, the issuing bank will nominate a bank. Such a bank is called nominated bank. Nominated bank will honor, that is, make side payment or accept a draft and pay on due date, or accept a deferred payment undertaking and pay on due date, or nominated bank will negotiate. What's a confirming bank? A confirming bank is a bank that adds a separate independent undertaking in addition to that of the issuing bank to pay on due date if the documents are complying and terms and conditions are met. What are the goods, services, or performance? The LC can be issued for any movement of goods, that is a commercial LC, merchandise, or services for erection, installation, commissioning, whatever it is, or for some other performances also. The LC payment is basically dependent upon the documents. The documents has to be compliant. Which documents? The documents stipulated under the credit. Compliance means what? It will meet the terms and conditions stipulated in the credit. And then if the documents are complying and if the presentation is found to be conforming, then it will be settled. How it will be settled? Either by honor or by negotiation. Honor is making side payment or accepting a draft and accepting the document and paying on due date, or undertaking to pay on a deferred date, a deferred payment undertaking. First we undertake to pay and then we pay on the deferred date. What is reimbursement? A nominated bank will be paying the beneficiary and will have to be reimbursed by the issuing bank. Reimbursement is payment by the issuing bank to the nominated bank, or payment by the issuing bank to the confirming bank and confirming bank to the nominated bank. This is reimbursement. This happens usually on the maturity date when the issuing bank finds the documents are compliant. Let's look at part 2. Here we shall look at when a LC comes into existence, how and when an LC comes into existence. We will look at the sales contract and the related aspects. What is a sales contract? When a buyer and seller decide to do a trade, preferably an international trade, because that is more in vogue today because of the globalization, liberalization, and privatization that's happening world over, and most of the trade is happening because of the multinationals, the seller undertakes to provide the goods. The buyer undertakes to pay the agreed price. So once the seller undertakes to provide the goods, he has to source the goods or procure the goods, and he has to find mechanism to deliver the goods, how to ship it, where to ship it, when to ship it, things like that. When the buyer undertakes to pay, the buyer has to arrange for funds. Either he has to take a loan or he has to find for buyer's credit and supplier's credit to pay for the goods. And he have to decide upon the methods of the payment, how the payment will be made, whether it will be under collection, whether it will be under credit, whether it will be open account, advance payment. These things have to be decided on. Thereafter, the buyer and seller will have to agree upon the goods. What are the goods to be supplied? The exact specification or description of what should be the goods, how much should be the quantity, what should be the quality, At what price, what is the unit price and what is the total price, and what are the breakups. If the price is suppose inclusive of insurance and freight and loading and packing and all these things, then what are the breakups, who will pay which portion, and how it is arrived at. This has to be decided upon. Tolerances and escalations has to be decided upon. Tolerance is that if 5 or 10% extra goods is sent, or 5 or 10% extra amount is claimed, will it be paid? And escalation is, will there be a change in the price for whatever reason? Maybe the market has moved, maybe the foreign exchange currency has moved, or maybe the quality of goods had improved, or maybe there is more demand in the goods. For so many reasons, there could be escalation. So, is there a price escalation clause? Or maybe for a delay in shipment, there could be a clause for penalty, liquidated damages. So, that should also be looked into or considered. Regarding goods, the parties should decide. The parties are the buyer and seller. They have to decide when it has to be delivered and how. When is the timing? It will be delivered on the particular date, or within a particular date, or within a particular period. And how? Is it by vessel, by aircraft, by road, by multimodal? The price they have to decide when it has to be paid and how. The price has to be paid when. That is, will it be paid at site against presentation of documents? And how it will be paid? It will be under LC, or is it open account, or documents? What documents are required? When it will be delivered? And how it has to be delivered? What documents means, is there a requirement for a bill of lading? And when this bill of lading should reach the buyer? Is it within 7 days of shipment, or is it not necessary? I mean, how it has to be delivered? Is it to be sent through the bank in the form of a documentary collection? If it is documentary collection, will it be documents against payment, or documents against acceptance, or cash against documents? These things will have to be decided between the buyer and seller. Maybe other terms will also have to be decided. If it is a letter of credit, how long it will be valid? If it is a documentary collection, up to what time the documents will be kept for acceptance or payment? And other things. Maybe do you need an inspection certificate? Should the origin of the goods be of matter or concern to these guys? Then once these things have been thought about and decided upon, the purchase order will be issued by the buyer, and the supplier will issue a pro forma invoice. Purchase order by the buyer will say what goods he wants, the quantity, the price, and the payment terms. The pro forma invoice of the supplier will say how he will supply the goods and how he wants the money to be paid. Now, this purchase order and pro forma invoice will have their own terms and conditions. Will have what are the standard terms and conditions of the buyer along with the purchase order, and standard terms and conditions of the supplier along with the pro forma invoice. Now, we need to have a consensus addendum. Consensus addendum is the parties should agree upon the same thing in the same sense, understand it in the same way. They should look, both of them should look at a particular point on the same angle. So if this is not there, if they are not able to have a consensus, then there will be disputes. So in case there is a dispute, it has to be resolved. If it has to be resolved, what's the jurisdiction that they think about? In which court of law they will have, and what are the laws applicable? Is it English laws? And how they will want it to be arbitrated if they are willing for arbitration. This also has to be looked at. Why? Because the terms and conditions of the buyer and seller that they are used to, or what they consider standard, are totally could be different from each other. To address all these issues, to make these issues easy and to facilitate international trade and to smoothen things and to grease the wheels, in 1980, United Nations came up with something called CISG, Contracts for International Sale of Goods. It's a United Nations Convention on Contract for International Sale of Goods. In that convention, a standard model form has been decided upon and agreed upon. Now today, there are 79 countries who subscribe to this CISG, which has been brought in 1980 by United Nations. You also have something called the UNCITRAL, the United Nations Contract for International Trade Law, Convention on International Trade Law. This talks about the payment mechanism, especially the negotiable instruments and related aspects for settlement of international trade. There are also model trade contract forms released by United Nations to be used for easy understanding and standardization of the trade. ICC had published publication number 715 first in 1936, and latest revision is to 2010. And this revision in 2010 is called Incoterms, the International Commercial Terms. This also tells what are the roles, responsibilities, or liabilities of the buyer and seller to a certain extent, so that when Incoterm is inserted into the contract, it helps us to take away some one-page terms and conditions which are normally part and parcel of the contract. What are these Incoterms? There are as on today 11 Incoterms, and 7 of them are pertaining to any mode of transport. These are X works, free carrier, carriage paid to, carriage and insurance paid to, delivered at terminal, delivered at place, and delivered duty paid. Let's take an example, free carrier. When it says free carrier, here you will have a port or a place which is the supplier's place. Suppose it is free carrier New York. That means the supplier will supply the goods, and he will load onto the carrier at New York. There, his responsibility ends, or in other words, the goods are supposed to have been practically delivered to the buyer when the goods are loaded onto the carrier at New York. This is the free carrier. So here we can understand that there is no need for arrangement of transport by the supplier. The supplier will not arrange for insurance. The buyer, though he will have to arrange for picking up the goods and transporting to his own place, he need not give any evidence or any document to the supplier with regards to carriage of contract, with regards to insurance contract. So these things need not be meant in detail. They can just say free carrier, New York, and it is all taken care. So these are the advantages of having an Incoterm. There are 5 more Incoterms other than XWorks, Free Carrier, CPT, CIF, DAT, DAP, and DDP, and those are rules for inland or sea waterway. This is when sea is the mode of transport. These rules are there. FAS is free alongside ship. FOB is free on board. CFR is cost and freight paid, and CIF is cost, insurance, and freight paid. Once we decide upon the Incoterm, and once we are ready to sign up an international sales contract, we have to decide upon the place of dispatch and final destination. Whether goods will be picked up from an internal place, whether it will be from an airport, whether it will be from a seaport, whether it will be picked up by the carrier or whether it will be delivered to the carrier, whether the contract with the carrier for carriage will be arranged by the shipper, will be arranged by the buyer, and is it multimodal, is it a mode by sea or is it mode by air, what transport document is required, how the goods has to be packed, how the goods will be moved, will it be a container shipment, will it on large barge, will it be a trailer, and then thereafter you have to arrange for the contract for carriage and insurance, what extent it should be insured 110%, what risk should be covered, jettisoning and washing on board, strike rights and civil commotions, who is responsible for arranging for the export license, customs clearances, security clearances of these goods on the importer's country, on the exporter's country, and suppose if the goods have to pass through another country, then who will arrange for export into that country permission or export from that country permission, import from that country and import into that country, those permissions who will arrange. All these things are addressed to a certain extent in the Incoterms, and the rest the buyer and seller have to be agree upon and then write it out in their contract if need be. Thus, the rights and responsibilities of the seller and buyer vary depending upon the Incoterm chosen. If it is a DDP, the supplier will have to pay the duties even for the import and deliver at the place inside the buyer's country. And if it is XWorks, the seller will leave the goods at his factory gates. XWorks is at his factory gates, and the buyer will have to pick up the goods from the factory gates and do whatever is required. Loading onto a receiving carrier has to be done by the buyer if it is XWorks. The supplier will not even load into a truck or a lorry, he will just place it at his factory gate. Thereafter, the buyer and seller in an international trade will have to discuss and decide upon the settlement terms, how the settlement will happen. Will the payment for this trade happen under documentary collection, under documentary credit, is it a standby credit or a documented commercial letter of credit, what it is. They can also have to decide whether it will be an open account. Open account is you supply the goods, keep on supplying the goods, and the other person will keep on paying, and there won't be necessarily a one-to-one match. At the end of maybe a quarter or a year, they will reconcile and say, okay, this much is a net outstanding. Payment in advances, the supplier will say, first you show me the money, and then I will show you my goods. That's it. Now there is something called the bank payment obligation, which is coming in vogue, which is there. Some 50-60 banks are already using it and customers are involved in it, where bank gives an undertaking that they will support the purchase order placed by the buyer. So this is a additional promise, but this is not exactly a letter of credit situation, but something that will facilitate an open account situation and that will help people move away from the advance payment situation. Documentary collection. In documentary collection, the documents are sent by the supplier to their bank. It's called the remitting bank. The supplier is called the principal. The remitting bank will send the documents to the presenting bank, and the presenting bank is the bank of the beneficiary. Sometimes there will be a collecting bank in between. The presenting bank will present the documents to the beneficiary, who is called the drawee, and they will have to accept the documents, and if it is sight, they will have to immediately pay. Only upon payment the documents will be released. If it is usance, then the documents will be released against acceptance to pay on a mature date or undertaking to pay on mature date. And if on maturity date or due date there is no funds in the account of the applicant, no bank is responsible to make payment, and then they are allowed to wait for it. If it is sight, and if the document delivery terms is against payment, then there is a guarantee that the buyer will not get the documents unless and until payment is made. So this is how the documentary collection works. Now, if in the documentary collection we are in an usance situation when it is 60 days after shipment, on maturity date, if there are no funds in applicant's account, there is a risk that the applicant will not pay or the applicant's bank will the presenting bank will not be able to collect the money and send it across to the principals or the emitting bank. To overcome this, we have a variation called avalization, where uh, the buyer's bank adds their own promise to the acceptance of the buyer, saying if the buyer doesn't pay, I will pay. This is just like a guarantee. The principal debtor is the applicant, or we should not use the word applicant here. We should use the word drawee here because it's a collection, and the buyer remains liable. And if the buyer, in case, is not able to pay, then the bank who had added their avalization or pour aval or co-acceptance will be remitting the funds. Then we have a documentary credit, which is the king or queen among the products in trade. Documentary credit is an issuing bank gives the promise that they will pay to the beneficiary against stipulated documents evidencing compliance with the terms and conditions. It's an independent, separate promise. There is a risk that the issuing bank may not be able to pay on due date for whatever reason. The bank is insolvent or bankruptcy, or maybe the country is not existing, or for so many other reasons. So to overcome these risks, we have a variation called confirmed letter of credit, where the beneficiary's banker add their confirmation to the letter of credit. Sometimes it is not the beneficiary banker, but a banker in a third country will add their confirmation to the credit. This is a separate undertaking, different from the issuing bank's undertaking, which says if the stipulated document evidencing compliance with the terms are presented, payment will be made. Now, what are the risks to the relevant parties? The risks to the relevant parties are different from each of these transactions. In an open account, the goods are supplied and they are waiting for the money. Money may or may not come on whichever day. And under advance payment, you are paid and you are waiting for the goods. The goods may or may not come when the buyer wants the goods. These are the risks. In documentary credit, in documentary collection, avalization, there are various risks, and as per the risk ladder, the risk varies when for each of these payment methods or payment terms. Now let us have a look at payment instruments. The buyer and seller will also have to decide whether there will be a payment instrument in addition to this payment term. Payment instrument could be negotiable instruments. Negotiable instruments could be drafts or bill of exchange. What is it? It's an unconditional promise. A draft or a bill of exchange is an unconditional promise by the drawer to the drawee to pay a certain sum after a specific period to a named payee. So this certain sum, the amount is fixed, the date is fixed when they will pay. The amount, whether they give a period or they give a date, and the payee, it should be named payee or it could be straight away to the drawee. And when it is drawn, it has to be signed or accepted by somebody so that it becomes the person who accepts the draft will become liable to pay. Many times the draft are drawn on the issuing bank when it is under letter of credit transaction. It can be otherwise also. It's an unconditional promise. The advantage of negotiable instrument is that it is a separate instrument. It is separate from the underlying trade or underlying letter of credit. And UNCITRAL and the Uniform Code, Commercial Code in US gives a lot of protection to the parties who are holding these accepted bills of exchange or accepted draft. In certain countries, there is a stamp duty applicable to the drafts at the time of acceptance, and so there is a trend towards not using draft to save the cost on stamp duty. But when you look at the advantages it offers, it is worth paying that cost. The advantage is that this can be separately used as a separate instrument, and in many countries can be dishonor of an accepted draft is a criminal offense. When an LC or when a normal trade transaction goes for a toss and it is into arbitration, it is a civil offense. While a dishonor of a draft will be considered as a criminal offense, and so you get more chances of getting it recovered, the proceeds recovered. Sometimes you can use promissory notes in lieu of the draft. Here it's there is a drawer and drawee. Here the promissory note, the person says I owe you. Promissory note is nothing but an I owe you. It is it. So I say that I owe you this much money and I will pay on due date. So there is a certain money, there is a certain date, and there is a certain named pay. But there is no drawer and drawee. It's I am promising. In case of a drawer and drawee, what will happen is the drawee will be the party who has to pay, and that party will have to accept that I will pay. What is the advantage of negotiable instruments like promissory note and bill of exchange? It's one is negotiability, which means the title can be transferred. How? By endorsement and delivery. And also these can be discounted or resold in the market. Discounting means if something is worth 100, payable 90 days from now, you can discount it and get 90 now, and then the party will realize 100 later, and this difference is his profit for having paid you in advance. Endorsement and delivery is the party in whose favor this has been issued. The payee can endorse saying please pay to XYZ and then deliver this document to another party who will receive the proceeds will become the owner and get the title transferred in his favor. These benefits are mostly available with an extra comfort in case if you are a holder in due course. If you are a holder in due course, the defects in the title will not affect you. If you are not holder in due course, sometimes the defects in the title will affect you. What's the defect in title? If this is not a proper properly accepted bill of exchange, or if it is so-called, to give a crude example, if it has been stolen by a thief and given to you, then there is a defect in title because that person did not have a legal right to own this and he had transferred it to you. So when he doesn't have a legal right to own it, he cannot transfer that title to you. So that is the defect in the title. So if you have taken it without notice of any defect in this title, if you had no reason to the doubt the defect doubt any defect in its title, if you have no doubt as to the person who is giving you is really uh, owning this or possessing this transaction in good faith, if you have taken it in good faith, and if you have taken it for valuable consideration, if you have paid something in return while taking this accepted bill of exchange, then you are considered as a holder in due course and the defects in title will not affect you. So this valuable consideration is that when a bank is negotiating a draft, the bank is giving you money and then taking the draft into their favor from you. So because they have taken the draft after giving you money or discounted proceeds, they are holder in due course and they can proceed against all the parties because they have parted with the money, they are due to receive the money. They should have taken it in good faith without notice of defect and valuable consideration should have been paid. Also, the negotiability is a great advantage when it is made payable to bearer or drawn to order, because by instead of endorsement and delivery, it can just be by physical delivery, the title can be transferred. Now, negotiable instruments are legally separate from the underlying transaction and the holders secure their right to claim payment, and these are actionable claims, and so this gives extra advantage. When there is a need for co-acceptance by a bank, a draft accepted by a buyer is having more weightage to be co-accepted than any other transaction. Co-acceptance is also called por aval, from which the word avalization is derived. The buyer and seller thereafter will have to decide upon the timing of the payment, when the payment will be made. Is it sight? Is it usance? X days after sight? X days after shipment? It could be advance or upon delivery or upon presentation and things like that. They have to thereafter decide upon the availability, credit availability. When, if it is a letter of credit, how it will be available. What is available? There are two things. One is available with and available by. Available by will be available by sight payment, available by deferred payment, available by acceptance, and available by negotiation. Sight payment is payment immediately upon citing a complying document. Deferred payment is undertake to pay on a deferred date and then pay on a deferred date. Acceptance is accepted the draft or the documents and then pay on the due date. Negotiation is negotiated the documents or draft and then agree to advance funds before the date the reimbursement is due. Available with is, it will be available with a particular bank, the nominated bank, or any bank in the beneficiary's country. Then we have a forfeiting and factoring. Factoring normally happens in domestic situations. Forfeiting happens in international situations, especially for larger values for medium terms. Forfeiting is normally without recourse, but with recourse, forfeiting is also seen in certain situations. There, the forfeiter will take an co-accepted bill of exchange and then give the money to you as a supplier. So you will, as a supplier, you will get the money immediately, and this will be a long-term transaction, 3 to 5 years. This could be in billions of dollars, and the payment as and when it is due from the buyer, it will be realized by a forfeiter, and he will take it. Sometimes in factoring, the sales ledger management will also be taken by the factorer, and the factor will also take care of the invoice management and other collection management and other things. So these are the methods in which receivables are managed. Now, these receivables could be discounted. That is, if $100 is due to the supplier, the supplier will get 90. This is called receivable discounted. Or the supplier will get 100, but draft will be drawn for 110 on the buyer, and buyer will have to pay 110, the 10 being the interest for being permitted a supplier's or a buyer's credit for this 90-day period or whatever. So this drawing a draft for a higher amount or discounting it for a lower amount is there, and these drafts which have been taken by the forfeiter or accepted by the bank can be rediscounted. If it is rediscounted in secondary markets, they will take it off from their balance sheet, and accordingly the liquidity situation of this transaction goes up still further. So these are some of the concepts that the buyer and seller will have to keep in mind while agreeing upon a sales contract. Now, there are some of the risks that these people face when they go in for a transaction. Applicant wants to pay only against compliant documents, or he wants to pay only on citing the goods. Because he cannot cite the goods, he wants to cite documents, and the document should evidence terms and conditions have been met. Beneficiary wants to release the goods only against payment or an agreement to pay. So what are the risks? The risks are the applicant is afraid of non-delivery, short delivery, or late delivery of goods, and then fall in quality or fall in quantity. He is also afraid of non-delivery, short delivery, or late delivery of the documents. If the documents may not come, or the goods may not come, or not satisfactory, and the for the party who is supplying, he is worried about the proceeds. The proceeds may not be delivered to him, or proceeds will be given short. Only a portion will be paid, or it will be paid with a delay. So that is the worry of the supplier regarding proceeds. Then there is also a risk of early shipment of or early submission of docs, or late shipment or late submission of docs. If the documents are submitted late, the buyer will not be able to pick up the goods from the port in time, and so he'll have to incur demurrage. If the documents are supplied earlier, the buyer will not be able to release the goods and sell it in the market, but he will have to pay for the documents when it comes to the bank under letter of credit. So those are the risks. Then there is a risk of loss of value. Maybe the price has changed or forex rate fluctuations happen. The loss in damage and transit. Loss of damage or transit is that during the transit by air or road or whatever, maybe you need to have an insurance for the transit or some other thing. Then what is the impact of the Incoterm? What is the Incoterm and who is responsible for what? Another risk is the failure of the bank or the country. There is a situation in the bank is in bankrupt, or there is a civil war in the country, and because of which the bank is not able to pay. This is one of the risks the beneficiary faces. Then there is a risk of fraud from the beneficiary's angle, a non-existent credit, a non-existent bank, a non-existent applicant, all the risks. And from the applicant's angle, non-existent beneficiary, non-existent document submitted, non-existent goods. These are the fraud risks which the applicant faces. Sovereign, regulatory, and legal risk are that after the supply has been made and before payment is received, something happens in the country, or some regulation comes up, or some legislation is thrown up, or a courts intervene and pass an injunction. There could also be a political or economic risk which cannot be gauged at the time of the transaction. So we have seen this non-existent goods or documents. There are so many problems or discrepancies that arise in the documents, because of which beneficiary is not able to get the payment. The discrepancies also arise because the applicant is not able to spell out exactly what he is looking for and what he wants. To avoid this, at the time of drafting the sales contract, at the time of drafting the LC application, at the time of drafting the LC, if the parties are willing to sit together and think through, then most of these discrepancies could be avoided, and the presentation could be conforming and complying, so that the cost and delay related to the discrepant documents could be avoided. So while drafting the LC, the type and nature of the goods, type and nature of the documents required, and type and nature of the terms and conditions called for in the credit will have to be kept in mind. And once this is done, the LC will become a workable and operative LC, and the beneficiary will be able to supply the goods and thereafter supply the documents which are complying, satisfactory to the applicant, and thereby make the transaction smooth and easy. Thanks for watching this part of the video. We shall meet again in another part of this series on Guide to Documentary Credits.